Hello everyone! Today we're diving into the world of bonds and debentures. These are two common investment options, but they can seem a bit confusing at first. Don't worry, I'm here to break it down for you in simple terms. Think of a bond like a loan. You lend money to a company or the government, and they promise to pay you back with interest. Pretty simple, right? Now, a debenture is a specific type of bond. It's also a loan, but it's not backed by any collateral like a house or a car. It's based on the issuer's creditworthiness. Both bonds and debentures can be great ways to diversify your portfolio and potentially earn a steady income. But like any investment, it's important to understand the risks and rewards before you jump in. So let's explore these investment vehicles in more detail. We'll look at bond yields, different types of debentures, and help you figure out which one might be the right fit for your financial goals. Let's get started. Now, let's talk about bond yield. It sounds complicated, but it's just a fancy way of saying return on investment. It's the amount of money you can earn from a bond. Imagine you buy a bond for $1,000 and it pays a 5% annual interest rate. That means you'll get $50 every year. That $50 is your yield. But here's the thing. Bond yields can change over time. They're influenced by factors like interest rates set by the Federal Reserve. If interest rates go up, new bonds will offer higher yields, and the price of existing bonds may go down. Why? Because investors are always looking for the best return. If they can buy a new bond with a higher yield, they'll be less interested in your older, lower-yielding bond. So understanding bond yields is crucial for making informed investment decisions. It's not just about the initial interest rate, it's about how that rate might fluctuate in the future. Now let's talk more about debentures. These are bonds that are not secured by any specific assets. They're backed only by the issuer's promise to pay. Companies issue debentures to raise capital for various reasons, such as funding expansions, research and development, or even paying off existing debts. Think of it like this. You're lending money to a friend based solely on your trust in them. You believe they'll repay you because they've always been reliable in the past. Debentures typically offer higher interest rates than secured bonds because they carry more risk. After all, if the issuer faces financial trouble, there's no collateral to back up your investment. However, debentures can be attractive to investors seeking higher potential returns. Just remember, higher returns usually come with higher risks. In the next section, we'll dive deeper into the risk and return aspects of both bonds and debentures. Stay tuned. Now let's talk about everyone's favorite topic, risk and return. The golden rule of investing is that higher potential returns usually come with higher risks. And that holds true for bonds and debentures as well. Bonds, especially those issued by the government, are generally considered less risky. That's because governments have the power to tax and print money to repay their debts. But because they're safer, they typically offer lower interest rates. Debentures, on the other hand, are considered riskier because they're not backed by any assets. If the issuer defaults, you could lose your investment. However, to compensate for this risk, debentures usually offer higher interest rates. So, which one is right for you? It depends on your risk tolerance and investment goals. If you're risk-averse and prioritize safety of principal, bonds might be a better choice. If you're comfortable taking on more risk for the potential of higher returns, debentures could be worth considering. Section 5 Illustrative Examples. Investing in bonds and debentures. Let's make this more real with some examples. Imagine you have $10,000 to invest. You could buy a U.S. Treasury bond, which is considered very safe. Let's say it offers a 3% annual interest rate. You'd earn $300 per year. Now let's say you invest that same $10,000 in a debenture issued by a growing technology company. This company is doing well, but it's still riskier than the U.S. government. To attract investors, they're offering a 6% annual interest rate. You'd earn $600 per year. See the difference? The debenture offers double the interest rate, but it also carries more risk. The company could hit a rough patch and default on its debt, while the U.S. government is very unlikely to default. These are just examples, and actual interest rates can fluctuate, but they illustrate the trade-off between risk and return that you need to consider when choosing between bonds and debentures. Section 6. Bond yields, advantages and disadvantages. Let's look at the good and the not so good when it comes to bond yields. One of the biggest advantages is the potential for stable income. Remember that $50 you were getting every year in our earlier example? That's the beauty of bonds. They provide a predictable stream of income, which can be great for retirees or anyone seeking regular payments. Another advantage is that bonds are generally considered less risky than stocks. While their prices can fluctuate, they tend to be less volatile than the stock market, especially in the long run. However, there are also some disadvantages. One is that the potential for growth is limited. You're essentially lending money at a fixed interest rate, so your returns are capped. Another downside is that inflation can eat into your returns. If inflation is higher than your bond's interest rate, your purchasing power will decrease over time. So, while bond yields offer stability and predictable income, it's important to be aware of their limitations, especially in a high inflation environment. Section 7. Debentures Advantages and Disadvantages. Now let's weigh the pros and cons of debentures. One major advantage is their potential for higher returns compared to bonds. Remember, higher risk, higher reward. If you're comfortable with some risk, debentures can offer the opportunity for greater profits. Another advantage is that they can provide diversification to your portfolio. By investing in a mix of bonds and debentures, you can spread your risk and potentially enhance your returns. However, it's crucial to acknowledge the disadvantages. The most significant one is the higher risk involved. If the issuing company faces financial difficulties, you could lose some or all of your investment. Another potential drawback is that debentures can be less liquid than bonds. This means it might be harder to sell them quickly if you need access to your money. So while debentures offer the allure of higher returns, they require careful consideration of the associated risks and potential for illiquidity. Section 8, which is right for you, choosing between bonds and debentures. So, we've covered a lot of ground today. We've talked about bond yields, debentures, their risks, and their rewards. Now, the big question is, which one is right for you? Well, like most things in personal finance, it depends. There's no one-size-fits-all answer. The best choice for you depends on your individual circumstances, risk tolerance, and investment goals. If you're risk-averse and prioritize safety of principal, bonds, especially government bonds, might be a better fit. They offer stability, predictable income, and are generally considered lower risk. If you're comfortable taking on more risk for the potential of higher returns, and you believe in the long-term prospects of a particular company, debentures could be worth considering. The key is to do your research, understand the risks involved, and make informed decisions that align with your overall financial plan. Section 9. Conclusion. Making informed investment decisions. Congratulations! You've made it to the end of our bond and debenture journey. You're now armed with the knowledge to make more informed investment decisions. Remember, investing is a marathon, not a sprint. It's important to have a well-diversified portfolio that aligns with your risk tolerance and long-term goals. And as always, if you're ever unsure about anything, don't hesitate to consult with a trusted financial advisor who can provide personalized guidance. Happy investing, everyone!